Imagine holding on to, say, up to 20% more of your hard-earned business income.
That's a pretty compelling thought, isn't it?
It really is. For entrepreneurs, freelancers, small business owners, look, this isn't just about saving a few dollars. It's about putting substantial money directly back into your pocket.
Money you can use, right? Fuel growth, invest, or maybe just breathe a little easier financially.
Exactly. And our mission today is to give you a direct shortcut, sort of a map, to unlocking those significant tax savings.
Yeah, let's clear the fog around this one.
Welcome, everyone, to the Deep Dive. Today we're diving headfirst into, well, a really crucial piece of tax legislation. Internal Revenue Code, Section 199A.
You probably know it better as the Qualified Business Income Deduction, or just QBI deduction.
Right. And this isn't just theory, is it? This is practical, powerful knowledge, stuff designed to help you optimize your tax strategy.
Especially with tax season always seeming like it's just around the corner, the stuff matters now.
That's right. For many, Section 199A remains one of the most impactful, yet often misunderstood tax benefits available.
It really is. We're going to pull back the curtain on this vital opportunity today, give you the core insights you need.
So you can understand its, well, profound potential impact on your finances.
Yeah, this deduction truly can be a game changer for many types of businesses. And understanding its nuances, the little details that can directly translate into substantial savings on your bottom line. It's worth the effort, trust me.
Okay, so when we talk about maximizing your tax savings, this Section 199A, it really stands out, doesn't it?
Oh, absolutely. It came out of the Tax Cuts and Jobs Act of 2017. Big piece of legislation.
And while people focused on, corporate rate cuts and other things, for many business owners, this deduction is arguably one of the most significant parts.
I'd agree. At its core, its basic function, it allows eligible businesses to deduct up to 20% of their qualified business income.
Sounds almost too simple when you put it like that, 20%.
It does on the surface. But that little word, eligible, well, it carries a lot of weight, doesn't it?
That's where the complexity starts creeping in.
Right. What's absolutely crucial for you, our listener, to understand right from the start is who this deduction is really designed for.
Okay, let's break that down. Who gets this benefit?
It's primarily targeted at what we call flow-through entities, or pass-through. Sometimes people say that.
Flow-through, meaning the profit flows through to the owner's personal return.
Exactly. We're talking about businesses structured as sole proprietorships, filing a Schedule C,
Yeah.
S corporations, limited liability companies, LLCs that are taxed as partnerships or sole props.
Okay.
And of course, actual partnerships.
So if you're an individual owner, or maybe the business is owned through a trust or estate, and that income flows directly onto your personal tax return.
Then this deduction is explicitly designed for you. It's meant to give those business structures a benefit somewhat comparable to the corporate rate cut.
So let's be clear then. If you're operating as a traditional C corporation, the kind that pays its own corporate taxes.
Nope. This specific deduction, Section 199A, isn't available to you. It's a very targeted benefit for those flow-through structures we just mentioned.
Got it. And it's not like a regular business expense, right? Like paying rent or employee salaries. Where does this deduction actually show up on your tax return? And why does that location matter so much?
That's an excellent question. And it's a distinction that often confuses people, actually. The Section 199A deduction is taken below the line.
Below the line. Okay, what does that mean in plain English?
Think of your tax return, maybe Form 1040, as having different sections. You start with all your income at the top.
Right.
Then you subtract certain deductions, they call them above-the-line deductions, things like student loan interest, maybe IRA contributions, to arrive at your adjusted gross income, or AGI.
Okay, AGI. That's a number a lot of things are based on.
It is. It's a key number.
Yeah.
But this 199A deduction, it comes after that. It's taken from your AGI to get to your taxable income.
Ah. So it doesn't reduce your gross business income on your Schedule C, for example.
No. And it doesn't reduce your AGI itself. Instead, it directly lowers your taxable income.
Which is the final number the IRS uses to figure out how much tax you actually owe.
Precisely. And that's why it's so powerful. It directly reduces the amount of income the government can actually tax you on. It's a direct hit to the bottom line of your tax bill.
That's a critical detail because it means more of your hard-earned money stays in your business or your personal finances.
Right.
This isn't some obscure credit that might phase out based on weird rules or something. It's a direct reduction of your personal taxable income.
A clear and potentially substantial path to tax savings. It truly is a genuine opportunity for many.
Exactly. It's not about fudging your business profit. It's about optimizing your personal tax burden related to that business profit.
And for many entrepreneurs, freelancers, small business owners, this is one of the most impactful deductions they can claim. Makes the effort to understand it really worthwhile.
Okay, here's where we move from the big picture, the what is it, to the critical details, the nuts and bolts.
Fine print, maybe.
Yeah, exactly. And look, this might feel a bit like learning a new language, but trust me, understanding these terms is absolutely foundational.
It really is. These aren't just, tax jargon for the sake of it. These definitions are the gatekeepers.
Gatekeepers, I like that. They dictate what income and what types of businesses actually qualify for this deduction.
And clarity here translates directly into potential savings for you. No ambiguity allowed if you want the deduction.
So let's start with the absolute core concept. Qualified business income. QBI. What exactly is QBI?
QBI, right. It truly is the engine of this entire deduction. In its simplest form, it's your ordinary business income minus your ordinary business deductions.
Ordinary income minus ordinary deductions. So basically the net profit from your regular business operations.
Pretty much. Think of it as the net profit from your trade or business conducted within the United States. That U.S. connection is important too.
Okay. And this applies whether you're a sole proprietor filing a Schedule C.
Yep, or a partner in a partnership getting a K-1.
Or a shareholder in an S corporation also getting a K-1.
Exactly. It's the core operational profitability of your enterprise before certain other things get factored in.
Okay, so it's your business's bottom line from its day-to-day stuff.
Mm.
But maybe more importantly, what doesn't count is QBI. Because I know there are some key exclusions that can really trip people up.
You're right. This is where precision matters. It's vital. Crucially, QBI does not include wages you earn as an employee.
Okay, so if I have a regular W-2 job and a side hustle that's a sole proprietorship.
Your W-2 wages from your main job, completely separate. They do not count towards your QBI calculation for your side hustle.
Got it. What else is out?
It also explicitly excludes guaranteed payments made to partners in a partnership.
Guaranteed payments. Why those?
The IRS views those more like compensation for services rendered to the partnership, kind of like a salary, rather than a share of the true fluctuating business profit. So for this deduction, they're out.
Okay.
Right.
And what about investment income?
Yes. Vital for anyone with investments. Dividends, interest income, and any capital gains and losses, long-term or short-term, they are also explicitly excluded from QBI.
Why?
Because those are generally considered investment-related income, not income derived directly from the active operation of a qualifying trade or business. This deduction is aimed at business income.
Okay, so no wages, no guaranteed partner payments, no investment income like dividends, interest, or capital gains. It's really focused on that operational profit.
That's the heart of it.
Now, speaking of deductions, I know QBI itself has to be reduced by certain things before you calculate the 20%. What are those adjustments, and why do you have to subtract them?
That's another excellent point and a common source of confusion. Your starting QBI must be reduced by certain deductions you take to arrive at your adjusted gross income, but only those that directly relate to that business.
Okay, like what?
The main ones are the deductible portion of your self-employment tax.
Right, the half you get to deduct.
Exactly. Also, any contributions you make to self-employment retirement plans like a SEP IRA or a solo 401k that are attributable to that business.
Yeah.
And deductions for self-employment health insurance premiums, again, attributable to that specific business.
And the why behind subtracting these?
It's pretty straightforward. The IRS wants to prevent a double benefit. You're already getting a deduction for these items elsewhere on your return above the line, typically.
I see.
So you have to subtract them from your business income before you calculate the potential 20% QBI deduction. It ensures the QBI figure reflects the income before this specific Section 199A benefit is applied.
Makes sense. So if you're self-employed, an independent contractor, or an owner in a partnership or S-corp, step one is getting your accurate QBI calculation right. Understand the income, understand the exclusions, and make those necessary reductions.
Absolutely. Get that number right, and you've laid the groundwork for claiming this deduction. It's foundational.
Okay. What's next in our definition list?
Next up is qualified property. Now, this term might not seem as central as QBI itself initially.
Yeah, sounds a bit secondary.
But it plays a really critical role when we get to the deduction limitations, particularly for higher income taxpayers.
Okay, so what is qualified property?
It's defined as any tangible, depreciable property. So stuff you can touch, stuff that wears out over time.
Like buildings, machinery.
Exactly. Buildings, significant machinery, specialized equipment, even vehicles used predominantly in your business, provided you depreciate them for tax purposes.
Okay. And what are the conditions?
The property has to be held by the business at the end of the year, and it must have been used at any point during the year in the production of that QBI we just talked about.
And crucially, it's tangible and depreciable. So not land, because land isn't depreciable,
Yeah.
and not inventory you sell.
Correct. It's about those long-term assets integral to operating your business that lose value over time. We measure it by its unadjusted basis immediately after acquisition, or UBIA, basically its original cost.
UBIA. Okay, we'll come back to why that matters later with a limitation.
We will. It becomes very important.
All right. Now, for what I think is maybe the most vital distinction in all of Section 199A, especially as your income starts to climb, the difference between a qualified trade or business, or QTB,
QTB.
and a specified service trade or business, SSTB.
SSTB, yes. This distinction, for many, is absolutely make or break for getting this deduction, particularly at higher income levels.
It really is. So let's start simply. What's a QTB?
A qualified trade or business, QTB, is, well, it's defined by what it's not. It's any trade or business other than an SSTB.
Okay, so if you're not one of those specified service businesses, you're automatically a QTB.
Generally, yes. If you don't fall into that specific SSTB category we're about to define, congratulations, you're a QTB for 199A purposes. And that's usually the more favorable classification, especially later on.
All right, so the million-dollar question then. What exactly is an SSTB? This is where it gets very specific, and I imagine a lot of listeners might be leaning in right now wondering if their profession is on this list.
It's a list you definitely want to pay attention to. An SSTB is a trade or business that involves performing services directly in a very defined list of fields. Let's run through them.
Okay.
We're talking health services. So, doctors, dentists, nurses, physical therapists, chiropractors, psychologists, vets, that kind of thing.
Right.
Law. Pretty straightforward attorneys, legal consultants,
Yeah.
accounting, CPAs, enrolled agents, bookkeepers, tax preparers,
Okay.
actuarial science, those folks who deal with risk and financial uncertainty.
Got it.
Performing arts, actors, musicians, directors, singers, entertainers.
Okay.
Consulting, providing advice and counsel to clients. This one can be a bit broad.
Uh-huh.
Athletics, professional athletes, coaches, team managers.
Right.
Financial services, financial advisors, wealth managers, investment bankers, planners, and brokerage services, which is also quite broad. It includes investing and investment management, or trading and dealing in securities, partnership interests, or commodities.
Wow. That's a lot of common professions.
Yeah.
Doctors, lawyers, accountants, consultants, financial advisors. Many service providers fall squarely into that SSTB bucket.
They do. The clear intent here, when the law was written, was to limit the deduction for certain high-income service professionals whose primary asset is arguably their personal skill or reputation.
Speaking of reputation or skill,
Mm.
there's also that famously vague, almost catch-all phrase in the definition, isn't there? The reputation or skill clause.
Mm.
That seems designed to expand the net even further.
It does, and it's a critical point of interpretation. It's caused a lot of discussion and, frankly, some ongoing uncertainty in certain edge cases.
But what does it say exactly?
The definition of an SSTB also broadly includes any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees or owners.
Principal asset is reputation or skill. That sounds like it could apply to almost any service business, couldn't it?
Potentially, yes. It could sweep in other service industries not explicitly listed, but that relied heavily, primarily, on the personal skill, talent, and reputation of the individuals involved.
Like who? Give me an example.
Maybe a highly sought-after celebrity chef, a famous author getting paid for endorsements based on their name, or even a specialized high-end wedding planner whose business thrives purely on their personal brand and connections.
So it's designed to prevent people from cleverly structuring their business, to avoid the SSTB label if the core value really comes from a person's individual talent or fame.
That's the idea. It emphasizes the personal nature of the service being provided, but the IRS guidance has tried to narrow it a bit, focusing on things like receiving income for endorsements or appearance fees. It's tricky.
It's a gray area to be aware of. But I also remember reading there are two very specific professions that get a special carve-out. They're explicitly not SSTBs, even though they seem like service businesses.
Excellent memory. Yes, there are two crucial exceptions carved right out of the SSTB definition: engineering and architectural services.
Engineering and architecture.
Right. Businesses providing these specific services are not considered SSTBs, even though they're clearly service-based professions relying on specialized skills.
Why is that important?
It's a huge planning point for professionals in those fields. It means their businesses are treated as QTBs, qualified trade, or businesses.
Which, as you said, is generally more favorable, especially at higher income levels.
Exactly. It potentially allows engineers and architects to qualify for the 99A deduction, even at income levels where other high-earning service professionals like doctors or lawyers would be completely shut out. A significant advantage.
So bottom line, this isn't just, bureaucratic jargon or some theoretical exercise. Whether your business falls into QTB or SSTB can dramatically change whether you qualify for any deduction, especially as your income grows.
Absolutely. Understanding your classification here is where strategic planning can truly pay off. It's paramount for anyone looking to maximize this deduction. Okay, so we've defined QBI, what income counts, and we've tackled the crucial QTB versus SSTB distinction, what kind of business you have. Now, let's look at the basic deduction calculation itself.
The starting point, before things get complicated.
Exactly. Before any of the various limitations kick in, the calculation itself is wonderfully simple. It's just 20% multiplied by your qualified business income, QBI.
20%. Right off the top of your QBI. That sounds, it sounds almost too good to be true, doesn't it?
It can feel that way. And honestly, for a large segment of small business owners, particularly those with moderate income levels, this is often exactly what they get.
So that simple 20% calculation holds true for many.
For many, yes. This is the ideal scenario, the potential maximum benefit you could receive if none of the limitations apply to your specific situation.
Let's put a number on it. If you have, say, $100,000 in QBI,
you're looking at a potential $20,000 deduction right there. Boom. Before any other adjustments or limits.
20 grand off your taxable income.
Exactly. It's a straightforward calculation in that ideal scenario, and it directly reduces your taxable income, offering potentially very substantial savings. It's the starting point, the aspiration, and for many, the reality.
That's a powerful number.
Yeah.
A $20,000 deduction on $100,000 of QBI can translate into thousands of dollars in actual tax savings, depending on your tax bracket, obviously.
Not easily.
But, and there's always a but in tax law, isn't there?
There usually is.
As good as that simple 20% sounds, we know there are nuances, complexities, and of course, limitations. This is where that simple 20% can get a little more intricate.
Indeed. While the basic calculation is simple and appealing, the real complexity and honestly where the most strategic tax planning comes into play is understanding how those various limitations can chip away at or even eliminate that initial 20% calculation.
And whether you ultimately qualify for the full benefit or just part of it, or maybe none of it.
Precisely. The limitations are where the rubber meets the road for many taxpayers. All right, let's transition now into those nuances, the limitations. And it's worth saying these limitations aren't just arbitrary hurdles. They were put in place for specific reasons.
Okay, what was the thinking behind them?
Generally, to prevent the deduction from being, well, overwhelmingly large, especially for higher earners or certain types of businesses that maybe didn't need as much incentive.
So trying to target the benefit.
Exactly. They aim to ensure some level of fairness and target the deduction effectively, making sure it primarily benefits who Congress intended and perhaps encourages certain economic activities. Think of them as guardrails.
Guardrails,
Yeah.
okay. Shaping the deduction's impact.
Yeah.
So what's the first major limitation we need to understand? You mentioned income earlier.
Yes. The first major hurdle, and arguably the most influential one, is based on your overall taxable income level. This is where your personal income, your total income picture, really starts to dictate how much of this business deduction you can claim.
So it's not just about your business's profit anymore. It's your whole household's taxable income.
That's absolutely right. The IRS sets specific taxable income thresholds, and these are before you even apply the QBI deduction itself. These thresholds get adjusted annually for inflation, so it's important to use the correct year's numbers.
Okay. What were they for 2023, for context?
For the 2023 tax year, the key range was for single filers and all other filing statuses except married filing jointly, so head of household. Married filing separately, the range was between $182,000 and $132,100 of taxable income.
$182,000, $132,100 for single filing.
Okay, and for those married filing jointly, the range was double that. $364,200 and $464,200.
$364,264,200 jointly.
Credit. And why is this range so critical?
Because whether your taxable income falls below that range, within that range, or above that range is absolutely paramount. It dictates everything else.
Like what?
It determines which other limitations might apply to you. And critically, as we'll see, it determines if a specified service trade or business, an SSTB, even qualifies for any deduction at all. Wow. Okay, so this income threshold is like the master switch for the other rules.
In many ways, yes. This is truly where your overall financial picture dictates your tax savings potential from this specific deduction. And it makes sense, right? It connects your personal finances directly to your business tax benefits.
It does. Okay, so income level is number one.
Yeah.
Then there's the limitation you hinted at earlier involving wages and property, the W-2 wage and qualified property limitation.
Yes, that's the next big one.
When does this one kick in, and what's the rationale behind it? Why wages and property?
This limitation becomes relevant once your taxable income starts hitting those higher levels we just talked about. Specifically, once you go above the lower end of those threshold ranges.
So above $182,100 for single or $364,200 for joint filers.
Correct. Once your income exceeds those points, this limitation starts to phase in or fully apply. And the design, the rationale, seems to be to favor businesses that contribute to the economy in specific, measurable ways.
So.
Either by employing people and paying substantial W-2 wages.
Okay, creating jobs.
Or by investing in tangible, depreciable property, making capital investments.
Right, buildings,
Yeah.
equipment, things you can see and touch.
Exactly. So when this limitation applies, your potential QBI deduction gets capped. It can't be more than the greater of two different calculations.
Okay, what are the two calculations?
Calculation one is simply 50% of the W-2 wages paid by the business that are allocable to the QBI.
50% of wages.
Calculation two is a bit more complex. It's 25% of those same W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition, UBIA, of all your qualified property.
25% of wages plus 2.5% of the original cost of property.
Wow.
Okay.
So you calculate both of those, pick the bigger number, and that becomes a potential ceiling on your 20% QBI deduction.
That's quite a calculation. But the underlying intent seems pretty clear, doesn't it?
I think so.
The government seems to be saying, we want to give this deduction, but we especially like it if your business has a significant payroll, employing people, or if you invest heavily in substantial long-term assets.
Precisely. It's a mechanism to align the deduction with certain types of economic activity, job creation, or capital investment. It encourages businesses, especially larger or more profitable ones, to either pay significant W-2 wages or have substantial depreciable property to maximize their deduction.
Less benefit for, say, a highly profitable business with very low overhead, few employees, and minimal assets once they hit those higher income levels.
That's generally how it works out. It's also worth quickly noting that this particular W-2 wage and property limitation does not apply to income you might get from real estate investment trusts, REITs, or publicly traded partnerships, PTPs. Those have their own simpler 20% deduction rule under Ontonin AA without this specific wage property test.
Okay, good clarification for REITs and PTP investors.
Yeah.
And finally, limitation number 3, the overall taxable income limitation. This sounds like the ultimate safety net, right? The final check.
It is indeed the final hurdle, the overall cap, for your total Section 199A deduction from all your qualifying businesses combined.
So if I have multiple businesses generating QBI,
this limit applies to the sum total of their individual QBI deductions after considering any other applicable limits, like the wage property one we just discussed.
okay. And how does this final limit work?
The total QBI deduction you can take for the year is capped at the lesser of two amounts.
Lesser of.
Amount 1 is the combined QBI deductions from all your qualifying businesses, calculated after applying any other limitations like the W-2 wage property limit, your potential total QBI deduction.
Right.
Amount 2 is 20% of your total taxpayer's taxable income before the QBI deduction, but, and this is key, in excess of your net capital gain.
Whoa. Okay. 20% of taxable income minus net capital gain. What counts as net capital gain here?
For this specific limitation, net capital gain includes the excess of net long-term capital gain over net short-term capital loss, and it also includes your qualified dividend income.
So if I have a really good year in the stock market, lots of long-term gains or qualified dividends, that could actually reduce the ceiling for my QBI deduction for my business.
Potentially, yes. That's exactly right. The purpose here seems to be to ensure your QBI deduction doesn't reduce your tax bill too drastically relative to your entire financial picture, especially when you consider other forms of income like capital gains and dividends that already get preferential tax rates.
So it prevents the QBI deduction from disproportionately benefiting someone whose income is heavily weighted towards capital gains versus business income.
That appears to be the intent. It ensures a more balanced approach to the tax savings across your entire income spectrum. It's like a final sanity check on the total deduction amount relative to your overall income profile.
Okay, wow. So recapping the limits. First, your personal taxable income level determines which rules even apply, below, within, or above the thresholds. Second, if you're above the lower threshold, the W-2 wages and property limitation might cap your deduction, incentivizing payroll and asset investment. And third, the overall taxable income limitation acts as a final ceiling, potentially reduced by your net capital gains.
You've got it. It's definitely more complex than just 20% of QBI, isn't it?
Absolutely.
Yeah.
But understanding these layers, these guardrails, is what unlocks the true strategy for maximizing your savings, or at least understanding why you might not be getting the full 20%.
It really highlights that your unique, complete financial situation dictates the final outcome. Hashtag tag V, who gets what? Understanding the three taxpayer categories.
Okay, this seems like a good point to maybe simplify things a bit. You mentioned taxpayers fall into categories based on income. Can we use those categories to see how these rules actually play out?
Absolutely. To make applying all these rules and limitations clearer, taxpayers can effectively be divided into three categories based on their taxable income before the QBI deduction.
Three categories.
Right. We'll focus most of our time on the two main categories, the ones below the threshold range and the ones above it, because they really illustrate the core mechanics. We'll also briefly touch on the third one, the tricky phase-out zone in the middle.
Perfect. Let's dive into category one first. This is for taxpayers below the lower income threshold, right?
Correct. Category 1 includes taxpayers with taxable income at or below that lower threshold amount. Just to remind everyone, for 2023, that was $182,100 for single filers, heads of household, etc., and $364,200 for those married filing jointly.
And this category, category one, this is where many small business owners and freelancers will find themselves, especially maybe those starting out or with more moderate income.
Exactly. And frankly, this is generally the most favorable scenario for the deduction. The rules are simplest here.
Okay, lay out the good news. If you're in this income bracket, how does Section 199A work for you?
The news is very good. If you have a qualified trade or business, a QTB, remember, that's anything not an SSTB.
Like our carpenter example earlier.
Right. You get the full 20% QBI deduction on your qualified business income, subject only to that final overall taxable income limit.
Full 20%. Nice. Now, what about the service businesses, the SSTBs, the lawyers, doctors, consultants? If their income is below this threshold, what happens?
And here's the real surprise for many listeners. The aha moment that often changes how people think about their service business if their income is moderate.
Okay.
If you have a specified service trade or business, an SSTB, and your taxable income is at or below this lower threshold, you also get the full 20% QBI deduction.
Wait, really? Even if you're a lawyer or a consultant?
Yes. Crucially, in this income range, neither the restrictive SSTB rules that normally disqualify them later, nor the W-2 wage and property limit apply. It's as if those limitations simply don't exist yet for you.
Wow. Okay, that is huge. So it really means that for small business owners and freelancers just starting out or with moderate income, the Section 199A deduction is both simplest to calculate and often most impactful, regardless of whether you're technically an SSTB or a QTB.
Precisely. An SSTB is treated exactly like a QTB here. This is huge, especially for service professionals who might otherwise read about the SSTB limits and assume they're completely out of luck.
Yeah, I can see how that happens. They hear SSTB limitations and just stop reading.
Exactly. Many service professionals mistakenly believe this deduction isn't for them at all, but for lower and moderate incomes, it absolutely is. Let's walk through a quick example to make this crystal clear.
Great idea. Let's use that carpenter again, Alex.
Okay, example 1. QTB with taxable income up to $182,100. Alex runs his carpentry business, a QTB, as a sole proprietor. It's single. His taxable income, after all other deductions but before any QBI deduction, is $50,000. Let's say he has no net capital gains this year, and his QBI from carpentry is $40,000.
Okay, $50K taxable income, $40K QBI, single filer. He's well below the $182,100 threshold.
Right. So step 1, Calculate the tentative QBI deduction. That's his QBI times 20%. $40,000 QBI, 20% is $8,000.
Simple enough. $8,000 potential deduction.
Step 2. Check the limitations. Does the W-2 wage and property limitation apply?
No, because his income is below the threshold.
Correct. Does the SSTB limitation apply?
Well, he's a QTB anyway, but even if he were an SSTB, it wouldn't apply because his income is too low.
Exactly. So those two big limitations are irrelevant here. Step 3. Check the overall taxable income limitation.
Okay, that's 20% of taxable income net capital gain.
Right. So $50,000 taxable income, $0 net capital gains, 20%. That equals $50,000, 20%, which is $10,000.
So the overall limit is $10,000.
Now we compare. Is Alex's tentative deduction $8,000 less than or equal to the overall limit, $10,000?
Yes, $8,000 is less than $10,000.
So he's not limited by the overall rule either.
Result, Alex's Section 199A QBI deduction is the full $8,000.
Yep. A clear $8,000 reduction in his taxable income directly translating to real tax savings. For someone like Alex, very straightforward and very beneficial.
That's fantastic. A really significant saving for someone with that income. Now, what about an SSTB in the same income bracket? Let's take Sarah, the graphic designer. Does she get the same beneficial treatment?
Let's run the numbers for Sarah. Example 2. SSTB with taxable income up to $182,100. Sarah is a freelance graphic designer, clearly an SSTB because it relies on her skill. She's also single, and her taxable income before the QBI deduction is also $50,000. So again, well below the $182,100 threshold.
Okay.
Let's say she had some investments that did well, generating $15,000 in net capital gains this year. Her QBI from her graphic design work is $40,000, same as Alex's.
Okay, $50K taxable income, $40K QBI, $15 net capital gain, single filer, SSTB.
Right. Step 1, tentative QBI deduction. $40,000 QBI, 20% is $8,000. Same potential deduction.
Okay.
Step 2, check limitations. W-2 wage property limit.
Doesn't apply income too low.
SSTB limitation.
Doesn't apply income too low. Even though she's an SSTB, the income protects her here.
Perfect. So again, those two major limitations are off the table. Step 3, overall taxable income limitation.
Now, this might be different because of her capital gains. It's 20% of taxable income net capital gain.
Correct. So $50,000 taxable income, $15,000 net capital gains, 20%. That's $35,000, 20%.
Which equals $7,000. So her overall limit is $7,000.
Now we compare again. Her tentative deduction was $8,000. Her overall limit is $7,000. Is the tentative deduction less than or equal to the limit?
No, $8,000 is greater than $7,000.
Exactly. So her deduction is limited by this overall cap.
Result, her Section 199A QBI deduction is limited to $7,000.
Right. Here's where that overall limit can kick in, even for lower incomes, especially if there are significant capital gains involved. It reduced her deduction from the potential $8,000 down to $7,000.
Still a fantastic saving for Sarah, $7,000 off her taxable income. But it's a subtle but really important point. Even if you're in that lower income bracket where most restrictions don't apply, that overall taxable income limitation can still bite you, potentially shrinking your final deduction.
It absolutely can. It highlights why looking at your entire tax picture, including investment income, is so crucial even when you think you're in the clear.
Okay, that covers Category 1, the good news zone below the threshold. Now, let's talk about the other end of the spectrum. Category 2, taxpayers above the upper threshold.
Yes, this is where things get much, much stricter. And that QTB versus SSTB distinction becomes incredibly impactful, often determining everything.
Okay, so Category 2 includes taxpayers with taxable income above the upper threshold. Remind us of those 2023 numbers again.
For 2023, that was income above $232,100 for single filers or heads of household, and above $464,200 for those married filing jointly.
Above those levels, and the implications here are stark, you said, potentially eliminating the deduction entirely for some.
Absolutely. For some, it's a complete cliff. This is where the deduction really starts to differentiate based aggressively on your business type and structure.
Okay, so let's take the first case. If you're a high-earning individual above that threshold, but you have a QTB, maybe a successful manufacturer, a restaurant owner, a retailer, what happens then?
If you operate a qualified trade or business, QTB, and your taxable income is above this upper threshold, the full W-2 wage and qualified property limitation always applies. No phase-in, it just fully applies.
The full limitation, meaning your deduction is capped at the greater of 50% of wages, or 25% of wages, plus 2.5% of property UBIA.
Correct. Your deduction is no longer potentially 20% of your QBI. Instead, it's strictly constrained by the W-2 wages you pay out in your business or the qualified depreciable property you own.
So even if your QTB is wildly profitable, generating huge QBI, if your payroll is relatively low or your depreciable asset base is minimal.
Your deduction will be capped, potentially significantly, by that W-2 wage and property limitation. Your QBI number almost becomes secondary to your wages and property figures in determining the deduction.
Which really underscores that incentive for higher income QTBs to either employ more people or invest in significant tangible assets if they want to maximize this deduction.
It does. It forces a focus on those factors. Now,
Yeah.
what about the specified service trader businesses, the SSTBs, in this high-income bracket, above the upper threshold?
Yeah, I have a thinking feeling about this one based on what you said earlier.
Your feeling is correct. For a specified service trader business, again, think doctors, lawyers, consultants, accountants, financial advisors. If your taxable income is above that upper threshold,
Yes.
no QBI deduction is allowed at all. Zero. Zilch. Nada.
Wow. Not limited, just gone.
Completely gone. It's a complete and total elimination of the benefit once you cross that upper income threshold. There's no phase out above the range, no partial deduction. It just disappears entirely for SSTBs.
That is incredibly stark, and it makes that SSTB classification absolutely critical for anyone nearing or exceeding those higher income levels.
It's night and day.
So let's summarize the implications here. If you're listening and you're a high-earning service provider in an SSTB field, this potentially powerful deduction effectively vanishes for you once your income gets too high.
Correct.
But for other high-earning businesses, the QTBs, the deduction doesn't necessarily vanish, but becomes directly dependent on your payroll or your asset base.
That's the key difference. It profoundly impacts tax planning for larger or higher income flow-through businesses. For QTBs, the focus shifts to managing wages and property. For SSTBs, the focus often shifts to managing income to potentially stay below the threshold, if possible, or accepting that the deduction is lost.
This isn't just about tweaking the deduction amount. For SSTBs, it's about whether you get any deduction at all, the cliff effect.
It really is, and that often requires sophisticated year-round planning. Let's look at two more examples to really hammer home this dramatic difference above the threshold.
Okay, let's use Michael, the manufacturer, a QTB.
Right. Example 3. QTB with taxable income of $232,100 or more. Michael owns a successful manufacturing plant. QTB is structured as an S-corp. He's single. His taxable income before QBI deduction is $240,000. That's clearly above the $232,100 upper threshold for single filers.
Okay.
Let's say Michael has no net capital gains. His share of the QBI from the plant is $100,000. His share of the S-Corp's W-2 wages paid to employees is $30,000. And his share of the UBIA of qualified property, machinery, building is $80,000.
Okay, $240K taxable income, $100K QBI, $30 wages, $80K property UBIA, single filer QTB, above the threshold.
Right. So first we know because his income, $240K, is above the max threshold, $232 1K, and it's a QTB, the full W-2 wage and property limitation applies.
No question about it.
Next, calculate the tentative QBI deduction. $100,000 QBI, 20% waste, $20,000. That's the potential starting point.
Okay, 20K.
Now apply the W-2 wage and property limitation. We need the greater of two amounts. 1.50% of W-2 wages. $30,000 wages, 50% equals $15,000. 2, 25% of W-2 wages plus 2.5% of UBIA. $30,000 wages, 25%, plus $80,000 UBIA, 2.5%. That's $7,500 plus $2,000 is $90,000.
Correct. So the W-2 wage and property limitation caps his deduction at $15,000.
Is that less than the tentative $20,000?
Yes, $15,000 is less than $20,000. Okay. So Michael's QBI deduction is limited down to $15,000 by this rule.
Okay. Do we still need to check the overall taxable income limit?
Always do the final check. The overall limit is 20% of taxable income at capital gain. So $240,000, 20% is $48,000. Is $15,000 less than or equal to $48,000?
Yes, it is. So his deduction is not further limited by the overall rule.
Result: Michael's Section 199A QBI deduction is $15,000.
Right. Notice how the W-2 wages, the 50% calculation in this case, became the key determining factor. It limited what would have been a $20,000 deduction down to $15,000. A clear illustration of how this limitation works for a QTB above the threshold.
It's a substantial haircut, $5,000 less, directly tied to his payroll level relative to his profit. It makes sense, given the incentive structure. Now, for the high-income SSTB, Laura, the consultant, The situation's even more dramatic, right?
Dramatically different. Let's use the exact same financial picture, just change the business type. Example 4. SSTB with taxable income of $232,100 or more. Laura is a highly successful management consultant, SSTB. She's single. Her taxable income before QBI deduction is $240,000, again, above the $232,100 threshold. No net capital gains. Her QBI from consulting is $100,000. She pays $30,000 in W-2 wages to assistants and has $80,000 in UBIA of qualified property office.
Same numbers as Michael, just an SSTB instead of a QTB.
Exactly. And the reasoning here is painfully straightforward for Laura because her business is classified as an SSTB and their taxable income, $240,000, exceeds the $232,100 upper threshold for single filers.
Sure, yes.
She is simply not eligible for any QBI deduction. The rule is absolute above the threshold for SSTBs.
Result: Laura's Section 199A QBI deduction is $0.
Zero. This starkly illustrates that for high-earning service professionals in an SSTB, this powerful deduction simply disappears entirely once you cross that upper income threshold. Doesn't matter how much QBI, wages, or property she has, it's gone.
Wow. $15,000 for the manufacturer versus $0 for the consultant, with the exact same income, QBI, wages, and property, just based on that SSTB versus QTB classification once you cross that income threshold.
It's a critical difference. This truly highlights why understanding this distinction is so vital for planning and why things like business structure and especially income management become so crucial for SSTBs near or above that limit.
It absolutely does. This difference alone could mean, thousands or tens of thousands of dollars in real tax savings or lack thereof. Okay, so that covers Category 1, below threshold, and Category 2, above threshold. What about middle ground, Category 3?
Right. Category 3 is the phase-out zone. This applies to taxpayers whose taxable income falls between the lower and upper thresholds.
So for 2023, between $182,100 and $232,100 for single filers, or $364,200 and $464,200 for married filing jointly.
Exactly that $50,000 range for single, $100,000 range for joint filers.
And I imagine this is where it gets incredibly complicated, where the rules start to kind of blend in transition.
Precisely. You nailed it. In this middle ground, this phase-out zone, things get even more nuanced and, frankly, computationally complex.
How so?
Essentially, the SSTB limitations and the W-2 wage and property limitations are gradually phased in across that income range. Think of it like a sliding scale. For an SSTB, the benefit doesn't just disappear instantly at the lower threshold. It slowly diminishes as your income rises through the phase-out range until it hits zero at the upper threshold.
And for QTB?
For a QTB, the W-2 wage and property limitation doesn't just suddenly apply in full force at the lower threshold. Its impact gradually increases as your income moves through the range, becoming fully applicable only when you exceed the upper threshold.
So you get a partial application of the limits within the range.
Exactly. The detailed calculation involves a complex formula that determines an applicable percentage based on how far into the phase-out range your income falls. It prorates the limitations.
Yikes. That sounds like something you definitely don't want to calculate by hand.
Honestly, it's truly beyond the scope of a deep dive like this, which focuses on the core mechanics and the clearer outcomes below and above the range. Tax software handles it, of course.
Right.
Just know that if your income falls into this middle zone, professional guidance is absolutely key. It requires a detailed, personalized analysis using those phase-in percentages to determine your exact eligible deduction amount. It's the most complex part of 999A.
Okay, wow. We have covered a ton of ground. From the basics of Section 199A, what it is, who it's for,
through the nitty-gritty definitions of QBI, QTB, SSTB, qualified property,
the core calculation, the three big limitations, income level, wages, property, overall income cap,
and how those limitations play out across the three income categories.
Let's try to bring it all together now. Let's talk about the key strategic implications, the main takeaways for you, the listener, thinking about your tax planning.
Good idea. Let's synthesize.
First, and maybe most importantly, it feels like your overall personal taxable income level is truly king here, doesn't it? It dictates almost everything else.
It undeniably is the primary determinant. Your total taxable income calculated before the QBI deduction is the single most important factor in how Section 199A applies to you.
It determines which rules apply, whether you get the full benefit, a limited one, or potentially no benefit at all, especially for SSTBs.
Exactly. And strategically, this means if you find yourself near one of those thresholds, either the lower or upper end of the phase-out range, managing your overall taxable income becomes critical.
How so?
Well, Things like timing deductions, maybe maximizing retirement contributions, or strategically timing income recognition, if done correctly and legitimately within the tax rules, could potentially push you into a more favorable category for the QBI deduction. It requires a holistic view.
Looking at your entire financial picture, not just the business profit in isolation.
Absolutely. You can't analyze the QBI deduction in a vacuum.
Okay, takeaway number one, income level is king. Takeaway number two has to be that SSTB versus QTB distinction. We saw just how dramatically that can affect the outcome.
It's huge, especially for higher earners, as we saw in the examples. It can literally turn a significant deduction into zero.
So understanding if your business is classified as an SSTB isn't just, an academic exercise or ticking a box.
Not at all. It's a direct line to knowing if you'll even qualify for this deduction as your income grows. For those in service professions, this is a critical piece of information you need to assess carefully.
And maybe even annually as your business evolves or your income changes.
Definitely. And for some, particularly those near or above the upper threshold, it might even lead to considering strategic questions about business structure. Can certain non-SSTB activities be legitimately separated? Though that's a very complex area requiring expert advice. Don't try that lightly.
Right. But the core point is, know your classification, QTB or SSTB. It's paramount.
Paramount.
And takeaway number three, particularly for the QTBs at those higher income levels, the power of payroll and property. It's almost like the law is nudging you in that direction.
It really is. For qualified trade or businesses with taxable income above those upper thresholds, the path to maximizing your QBI deduction runs directly through paying W-2 wages or investing in qualified depreciable property.
Like new machinery, a commercial building, maybe company vehicles.
Exactly. Those actions can directly increase your eligible deduction limit, turning potential QBI into actual tax savings. It provides a clear incentive for businesses to grow their workforce or invest in tangible assets.
It's a strategic lever that higher income QTBs can actively pull. A crucial consideration for capital-intensive businesses, or maybe those planning to expand their team anyway.
It absolutely should be part of their planning conversation. How does this investment or hiring decision impact our 199A deduction?
So pulling it all together, this deduction isn't just about plugging numbers into a tax form at the last minute, is it?
Definitely not if you want to optimize it.
It's about understanding the structure of your business, the nature of the services or goods you provide, your overall personal financial picture, and how those interact with these specific rules.
Exactly. It almost requires a deeper look into your business operations and how they intertwine with your personal tax situation throughout the year, not just on April 14th.
It's about identifying those opportunities for legitimate tax optimization through proactive planning.
And avoiding pitfalls, right? Common mistakes we see include not accurately tracking all the deductions needed to calculate QBI correctly, misinterpreting that SSTB definition, or maybe completely overlooking the W-2 wage and property limitation as a business grows and income rises.
So maybe the big aha moment here, the ultimate takeaway for everyone listening is this. The Section 199A deduction isn't a one-size-fits-all benefit.
Not even close.
It's really custom-tailored, almost personalized, by your specific income level, your business type, QTB versus SSTB, and if your income is high enough, your business's W-2 wages and depreciable assets.
That's a great way to put it, custom tailored by those key parameters.
And knowing those parameters, understanding how they apply to you, can be incredibly empowering. It gives you the knowledge to make informed decisions.
Decisions that can directly impact your financial future and your tax burden. Knowing these rules means you can potentially plan proactively.
Not just reacting at tax time, but maybe strategically positioning your business activities or managing your income throughout the year to capture the maximum legitimate benefit this deduction offers.
That's the goal of understanding this stuff. Hashtag tag tag outro.
Okay, so let's recap quickly. Section 199A offers a significant potential tax deduction up to 20% of qualified business income for owners of flow-through businesses, full props, S-corp, partnerships, LLCs.
But its availability and amount are heavily influenced by key factors. Your overall taxable income level, whether your business is a QTB or one of those specified service trades or businesses, SSTBs, and for higher earners, your business's W-2 wages and investment in qualified property.
It's a complex but potentially very rewarding piece of the tax code.
Definitely worth understanding for almost any business owner.
So here's a final thought for you, our listener, to mull over. As you consider your own business and financial situation, think about how the structure of your entity, your income level, even your decisions about payroll or buying equipment might be directly influencing the amount of tax savings you can unlock through deductions like Section 199A.
Yeah, ask yourself, what small change, what shift in understanding or planning could potentially make a big difference for your bottom line this year when it comes to this deduction?
It's definitely worth exploring. We highly encourage you to review your own situation, maybe dust off last year's tax return with these concepts in mind.
And look, this stuff gets complicated fast. If you're unsure or if your situation involves those phase-out ranges or complex structures, seriously consider consulting with a qualified tax professional. They can help you apply these insights directly and accurately to your specific circumstances.
Absolutely. Ensure you're taking full advantage of all the legitimate opportunities Section 199A offers without making costly mistakes.
That's the smart move.
Thank you so much for joining us on this deep dive into the intricacies of Section 199A.
We hope this has provided you with valuable insights and maybe demystified this powerful deduction a bit.
And truly empowered you to better understand your potential tax savings. Until next time, keep digging deeper.